How to build wealth safely and consistently in the stock market. Is that even possible? Forget everything you've heard about guaranteed profits. The truth is, there's no such thing. But there is controllable risk. And that, my friend, is the secret the pros use to build fortunes. This isn't about gambling. It's about strategy. Today, I'm going to pull back the curtain and show you the elite playbook for steady, predictable growth with controlled risk. By the end of this video, you'll have a complete professional guide to building wealth, like the best in the business. First, let's redefine safety in the stock market. It's not about zero risk. It's about control, predictability, and smart management. A safe investment is one with low volatility, backed by solid assets, protected by hedging strategies, and part of a diversified portfolio. Investing safely isn't about avoiding risk. It's about getting paid for taking intelligent risks. Your profit is the reward for managing risk wisely. So, how do you do that? It all comes down to the tripod of consistency. Pillar 1. Intelligent diversification. This isn't just about buying a bunch of different stocks. It's about balancing different asset classes. Stocks, bonds, real estate funds, commodities, even currencies like the dollar. This is the most effective way to cushion your portfolio against market shocks without killing your returns. Pillar 2. Continuous risk management. Professional investors measure and control their risk. They use tools like stop-loss orders to limit potential losses and position sizing to ensure no single investment can sink their entire portfolio. They also rebalance periodically, selling some winners and buying more of what's down to maintain their target allocation. It's disciplined and unemotional. And the third pillar, the one that truly builds wealth, is strategic reinvestment. The dividends and profits you earn aren't just for spending. They're for buying more assets. This is the magic of compound interest in action, the single most powerful force for multiplying your money safely over the long haul. This is how you turn a small, consistent stream of income into a massive river of wealth over time. Investors who win consistently live by a set of non-negotiable rules. 1. Preserving your capital is more important than chasing quick profits. 2. Earning a little bit consistently is far better than aiming for a home run and striking out. 3. Every decision is driven by data, not by fear or greed. And 4. Real fortunes are built with time, not in a hurry. These principles are the backbone of a successful strategy. Patience and discipline always beat impulse and risky bets. Now, let's get into the practical strategies the pros use. First up, the dividend and passive income strategy. This involves buying shares in stable, profitable companies that regularly share their profits with investors. Think of essential sectors like banking, electricity, and consumer staples. These companies tend to be less volatile. They provide a steady stream of cash, and you can reinvest those dividends to accelerate your growth. Look for companies with a solid dividend yield and a history of growing their profits. Another powerful and simple strategy is investing in index ETFs. Instead of picking individual stocks, you buy the entire market through funds like BOVA11, which tracks Brazil's Ibovespa, or IVVB11, which mirrors the American S&P 500. This gives you instant diversification across hundreds of companies, drastically reducing individual stock risk. Historically, the S&P 500 has returned about 10% per year on average over the long term. It's a proven, low-cost way to capture market growth. Then there's value investing, the strategy made famous by Warren Buffett. The idea is simple: buy great companies when they're on sale. You analyze a company's fundamentals, its profits, debt, and competitive advantages and buy its stock for less than its intrinsic worth. This margin of safety protects you from overpaying and increases your potential for profit when the market recognizes the company's true value. You're investing in quality at a discount. But what about protecting yourself from market crashes? That's where hedging comes in. Professionals use instruments like options or hold assets like gold and the US dollar to protect their portfolios. For example, buying put options is like buying insurance on your stocks. If the market falls, the value of these options goes up, offsetting some of your losses. Holding a portion of your portfolio in assets that typically rise when stocks fall is a smart way to smooth out your returns. Now let's put it all together in a sample professional portfolio. Imagine a well-balanced structure for a moderate investor. It might look something like this: 40% in broad market ETFs, like the S&P 500 and Ibovespa, 20% in high-quality dividend stocks for income, 15% in fixed income assets to act as a shock absorber, 10% in real estate funds for diversification, 10% in gold, dollars for protection, and 5% in cash, ready to deploy when opportunities arise. This structure is built to withstand storms and capture growth globally. But even the best strategy in the world is useless without the final secret ingredient: emotional control. The market is a machine that transfers wealth from the impatient to the patient. Fear and greed are your worst enemies. Professionals know that market drops are temporary opportunities, not a reason to panic. Your ability to stay disciplined and stick to your plan during turbulent times is what will ultimately determine your success. The real power behind all these strategies is time. Thanks to compound interest, reinvesting your returns transforms average gains into an extraordinary fortune. If you invest 1,000 reais every month with a 10% annual return, you could have over 2 million reais in 30 years. Time is the greatest multiplier of wealth, but only if you stay consistent and reinvest your earnings. So, investing safely and profitably in the stock market isn't a fantasy. It's a tactic. It requires intelligent diversification, rigorous risk control, disciplined reinvestment, and a healthy dose of patience. The security comes from the predictability of your method, not the unpredictability of the market. Follow the plan, master your emotions, and you will build wealth with a consistency that feels almost guaranteed because it's built on method, not on luck. Thank you so much for watching. If you found this guide helpful, please give it a thumbs up. And don't forget to subscribe for more professional investing strategies. See you in the next video.